G'day, welcome to Lunch Money. My name is Nick Samios. I am the Director and Fund Manager here at Hermes Capital, and I am your Lunch Money live stream and podcast host. So a very warm welcome to you. Today we are I've got Mark Robinson on. Mark Robinson's an insolvency and business restructuring specialist, and we're going to be talking about some of the latest data to come out of the RBA. We're going to be talking about some of the latest insolvency statistics, and we're going to do all of that so that we can give some context to our real discussion, the real meat on the bones, which is going to be a talk around with the eastern, certainly the southeast corner of Australia is going to be opening up soon, and that means that the training wheels, the guardrails that the government's been providing are going to come off. So what should small and medium-sized businesses be thinking? What are the big decisions and the big questions and the big traps and pitfalls they should be looking out for? That's what we're going to be discussing with Mark Robinson. Before we get to Mark, I would like to start off by saying our sponsor for today's podcast is Hermes Capital. Hermes Capital is an investment fund that has been providing loans to SMEs in outside-the-box situations for over 10 years. Hermes was born in the GFC and knows its way around troubled landscapes. Contact Hermes for bespoke non-bank solutions to your capital-raising needs. Okay, now without further ado, I'm going to introduce Mark Robinson. Anything exciting?
I think what everybody's excited about is potentially an early winding back of the lockdown and particular flow on into people's personal lives, and that impact on the business side is obviously going to be heavily felt, in the hospitality, restaurants, retail side of things. So I think that's the subject of excitement at the moment.
Now, of course, one of the problems with having you is, I think this is the third time that you've been on our show, and of course, I've known you many years, so I sort of forget sometimes to formally introduce you because not all of our guests have watched all of our shows. So Mark Robinson is an insolvency and corporate restructuring and personal bankruptcy specialist. He is a partner at the insolvency and business turnaround firm DVT Group here in Sydney, and so I guess that's why he's so keen to get out of lockdown. Now, Mark, why don't we just get straight into it? We'll get straight into our material, and we're going to start off by asking you what exactly is going to change. And we've got a graphic for that. Here we go. Yeah.
Yeah, look, a number, obviously as the lockdown winds back, a number of the government support measures, both state and federal, are going to wind back. One of the key ones here in New South Wales is JobSaver, which was a federal scheme, but then to enable it to continue on for a bit longer period, the New South Wales government stepped into the breach, and that's been a major help in terms of boosting cash flow, particularly for SME businesses. But that's been wound back. As of today, it's wound back from a 40% share of weekly payroll to 30%. As we hit 80% double dose vaccination, it'll wind back to 15% share of weekly pay, wound back, various other support measures such as the regime under which landlords are meant to abide by. That's been wound back as well. Those special provisions there in terms of abatement and delay of rent, that'll all be wrapped up by early to mid January, and a corollary of other support measures are being wound back, including financiers, wanting to bring, their outstanding loans back into terms. And so that's what's happening at the moment, is the wind back of support in anticipation of, businesses being able to get back on their feet as the lockdown restrictions ease.
Now, I know that one thing, I don't know, I'm sure you look at lots of financial statements, obviously being an accountant amongst other things. Yeah. It has been interesting to see how many sets of 2021, June 30, 2021 accounts. You look at the profit and loss statement and you look at the line item for JobKeeper / JobSaver, and you go, well, what happens if you take that number out? and a lot of companies do end up in the red. So there's no doubt that it's kept a lot of businesses afloat.
Yeah, look, it's around a timing difference, basically, isn't it? I mean, we're hoping as these support measures wind back, revenue increases as a consequence of the lockdown restrictions easing. Let's hope, for most businesses, revenue comes back quickly, to plug the hole that support. Of that withdrawn support. Obviously issues will arise for those businesses where, revenue stroke cash flow, and more particularly cash flow, if that's slow to come back, that'll place many businesses, particularly SMEs, in a spot of bother.
All right, look, we've got lots of charts to get through before we get to our discussion. So just the next one is something I saw on LinkedIn yesterday and this is courtesy of Patrick Schweitzer at Alares. And I did ring Patrick yesterday and asked him for permission to use this, although he did broadcast it on LinkedIn. But Alares, I don't know if you subscribe to them, Mark, but they provide some fantastic data. I'd certainly suggest that you friend Patrick on LinkedIn so you get these updates. But these are the winding up applications initiated by the ATO and non-ATO. And you can see the ATOs in blue there. So historically, it is hysterical. Freudian slip there. Historically, the ATO is behind a lot of the winding up actions against companies. But as you can see, really, since this whole pandemic has started, the winding up applications have dropped away. They sort of started to make a bit of a comeback earlier this year, but then lost a bit of interest once we went into lockdown 2.0. But the ATO's gone, and you were talking before in that first graphic when you were talking about those job saver coming off, those measures coming off. The support that nobody except people like you and I talk about is the tacit support of the ATO in not doing any sort of enforcement activity whatsoever.
Yeah, absolutely. And as we discussed earlier, the real vital statistic to monitor from the ATO is what they deem to be their collectible debt. And as we discussed before, they're due to announce where that balance currently sits. I think we all expect that to have significantly increased, and so the big question is basically when is the ATO going to take some positive, proactive steps in reducing its level of an increasing level of collectible debt. That mixed in with federal politics and timing of elections, etc., and the ATO not wanting to be a political football. It's going to be very interesting around the timing of when the ATO steps back into the market and tries to collect its collectible debt.
Well, if we can just flick back to that slide of Patrick's, I was chatting with Patrick, and by the way, we'll put a link in the show notes. We'll put a link to the report that Patrick put on LinkedIn. So just again, a special thank you to Patrick. Now there was an article in the Broker magazine, and there was a lot of excitement this week, both as you can see amongst finance brokers, but also people in corporate restructuring. The ATO a while ago was given the power to list companies that were in default, if you like, or in arrears on their tax, to list them on the credit reports. And a lot of people thought, well, firstly, that means if you're going to get listed, then people are certainly going to be more proactive about dealing with the ATO rather than have their credit file blotted by an ATO listing. And then there's a lot of people saying, oh, that's tough on the ATO, that's tough on business. But on the other hand, if I'm supplying a builder with timber, I'm a timber wholesaler, I'm supplying a builder with timber, and the ATO is sitting on a mountain of tax arrears, it might be nice for the ATO to do some reporting. But my feeling, the thing about this is, it's only if you're over $100,000 in debt, and it's only if you don't engage. So if you don't return the ATO's phone call for 3 months, okay. But otherwise, I don't really think this is a big deal. What do you think, Mark?
Look, I tend to agree with you. That's certainly one piece of advice that we give as advisors to debtors, is to communicate with the ATO, just in terms of your current situation, but then also in terms of things such as repayment plans, if they're viable, etc. The ATO in the current environment, as long as you're doing that communication piece and being transparent, is more often than not willing to sit back. I agree with your comments there.
Okay. Now, just a reminder, if we get 3 good questions today from our live viewers or live listeners, it has to be 3. If we get 3 good questions, then we have a special prize this week, and that special prize is a signed copy of 2 books from a speaker that we had a couple of weeks ago, Mike House. And he's got 2 books. One's called Unshakable and one's called Thrive and Adapt. So if we get 3 questions, then we'll let Mark choose what the best question was to give away those 2 books. We do also have, to all questions, we'll also receive our mug as usual. And we've got people back in the office next week, so we'll be able to start sending our backlog of mugs out. Okay, so again, to set the scene, we've just go to our next slide, which is what we all know, you and I certainly know, Mark, is this decline, obviously, in external administrations. There's not a lot of formal restructuring work around. Again, it started to make a bit of a comeback earlier this year, but then when Delta came along, it started to drop away. And obviously, I'd say that you concur with that.
Yeah, I do. And basically the 2 drivers of that are, less creditor pressure coupled with the further support, but then also creditors are now more generally, open to informal arrangements, which won't obviously reflect themselves in external administrations.
I guess so. Informal arrangements are dangerous, though, aren't they?
Look, the problem is if you've got more than a handful of stakeholders, is being able to bind all of them at the same time. If you can only bind a couple of them and a few of them you can't bind and they commence winding up proceedings against you, for example, well, you're just throwing good money after bad. So the advantage of formal appointments is that it binds everyone.
It's interesting, I'm seeing, I don't know whether it's just because where I'm looking, but I am seeing more activity in WA, maybe because, when you speak to WA people, they're living normal life practically, except for the fact that they don't have the likes of me coming to visit them. And I just wonder, because their life is sort of as normal as possibly could be, they are seeing more of this kind of activity. Look, we're just going to walk through some slides from the latest RBA chart pack. And we can just I'll just ask you to comment if you think need be. The big talk at the moment is inflation. Now, neither of us are economists, so you're not getting economist perspectives on this. What you're getting is battle-hardened views from the trenches of real life people here. So now the trouble is, people have been denying that there's inflation, but I mean, we're seeing it every day. It is pernicious when it comes to company profits. I guess it leads to asset price inflation, which I guess can help you in recoveries, and it might also help in borrowing power. Any comments on inflation?
Oh, look, it's from an accountant's perspective, it's all about the ability to pass on those price rises due to inflation to your customer base. Again, it's a timing difference. If you can't manage that timing difference and plug any gap cash flow wise that arises, you could get yourself into a bit of trouble. But it's your ability to pass on those rising costs to your customer base.
Well, of course, the other thing is that your customers are people that go shopping, and then because they're going shopping and buying goods for high prices, they want higher salaries, and then you get wage pressure, and then I guess you could end up with a bit of stagflation if the economy doesn't rebound. But okay, let's go to our next slide, which is GDP. I mean, the GDP has been, we had a technical recession. There's talk that we might have another technical recession. On the other hand, there's a lot of talk of revenge spending. As soon as the shops open up, you're going to get trampled in the stampede. What's interesting is, I'm not an economist, so I don't really know exactly how to interpret these numbers, but we do have a graph of the factors contributing to GDP. Consumption is the one that's knocking it out of the park there. If it wasn't for strong consumption, I guess people sitting at home and ordering stuff online, you'd have to wonder where we are.
Exactly right. If for whatever reason consumer confidence is not knocked for six, where things aren't looking good.
Yeah. Okay. We won't dwell too much on all of these. All we're trying to do here is to paint a picture for where we're at in terms of small business. So the next one. Now, what's interesting here is the next graph shows private dwelling investment, and you can see there that it fell away in recent years, but lately, the last 18 months, private dwelling investment's been through the roof. It's counterintuitive, I guess. Sitting here, if you were in March of last year, you would have thought that house prices would collapse, but of course, when you're in an environment of practically zero interest rates, lots of money about the place, these property prices have gone through the roof, I guess, which means people's ability to borrow against those properties have obviated the need for them to restructure their businesses. Would you say, Mark?
Oh, well, particularly in the SME space, where your property, your residence is quite often a significant form of security. And look, if that's looking solid in terms of form of security, it gives financiers comfort that they've got coverage at the end of the day. So, yeah, it reduces there being the prospect of there being a trigger point to affect a recovery.
Okay, look, let's just skip through the rest of these. The next one, so bear in mind that private investment's been solid in the property, but then when you look at business investment, it's been it's been certainly tapering down over recent years, but it hasn't been doing well of late. Investment in machinery and equipment's ticked up a little bit recently, but overall investment's been down. Our next slide shows lending to business, which has been trending up a little bit in in medium and large businesses, but has pretty much been flatlining for SMEs.
Yeah.
Comment there, Mark?
Yeah, look, and certainly the federal government's identified that lending into SMEs flatlined a bit. So there is a good support scheme that is still available, being the SME loan recovery scheme, to which SMEs can borrow up to $5 million over 10 years with some pretty nice sort of repayment holidays sort of mapped in there at a reasonable interest rate, because federal government guarantees 80% of the funds that go out the door. And so, certainly Treasury has identified that lack of lending into a SME as being an issue and is actively encouraging it.
Look, I actually have a problem with that. I mean, firstly, that scheme's not working. It's about as successful as the small business restructuring's been, and I'm not going to put up the small business restructuring statistics, because all you'd have is a chart and you'd have to try and find where the numbers are on it. But my mail, and we've talked about this before on Lunch Money, my mail is the banks don't like it because they're still on the hook for 20%. And there's just not that much demand for credit, which we'll come to in another slide. So you can see this one here. This shows growth in broad money. Now, this slide was first shown to me, I think, by Martin North. He loves this one. You can see broad money, which is effectively the money supply, has been growing. It certainly kicked up strongly last year. It's still been growing this year, but the demand for credit hasn't matched it. So the demand for credit, yes, it's kicked up this year, but it hasn't. So the demand for credit has not kicked up as much as the creation of money. And as a result, you've got pools and pools of cash about the place. So we're not seeing the demand for money is anemic, and there's plenty of money around. Now, to me, that has the makings of trouble. There's a lot of money. It means that people, their investment criteria get lower and lower and lower. But who knows? I could be wrong. The proof's not in the pudding of the eating as yet. Next slide. And you can see where all the money came from here. You've got the Reserve Bank's balance sheet. And, it's staggering. It's practically doubled. And that's been through bond buying, which I guess is no surprise. We'll keep going because I want to get through these. And then you've got this chart, which I've shown before, which is the latest chart of banks' non-performing assets. And again, they ticked up during the GFC, but ever since then, non-performing assets have been flat. So I think to some extent, a lot of non-performing assets have migrated from bank balance sheets to non-bank lenders. But any other thoughts on that, Mark? Does that surprise you, or?
No, it doesn't. There's a lot of, supporting a comment that there's a lot of private money out there. They're probably not pricing risk appropriately, and so they're plugging a lot of holes at the moment.
Okay, all right. Now, so we've painted a picture there. Obviously, there's a lot of businesses. There's corporate restructuring activities being down, which means there's a lot of businesses there. What you've called but for COVID viable. So just explain. That's a nice little term. What do you mean by but for COVID viable?
Well, your classic but for COVID viable business is your retail or hospitality business that is absolutely being impacted by COVID in terms of lack of revenue, inability to perform business, and also an inability to control some overheads that have got to continue during COVID. But nonetheless, if it wasn't for COVID and if the business factors return to normal, the core business would be viable.
Okay, so so if it wasn't for COVID, they'd be viable. But COVID's come along and blown a hole in them one way or another.
Yeah.
So I guess those businesses have a number of options. I mean, one of the options is to hang in there. One of the options is to close. And I guess another option is to be proactive about the whole thing. So let's look at the shelter in place option first. The hang in there. If you've have you got a didgeridoo in the background? There's something.
No, unfortunately, a neighbour that's about 2 floors below me has just decided to start up a jackhammer. So.
Oh, okay, nice, very nice. Okay, good timing.
It's not my stomach; it's a jackhammer.
Okay, it's probably one of your competitors or one of our competitors. So nicely played, whoever you are. So hang in there, like just shelter in place and hope for the best. Close the business and just walk away. Or thrive. Now, the reason I've got the close option there is I saw a LinkedIn post, and actually I saw on the ABC's The Drum, Angela Vithulkas. Angela is she's a councillor on Sydney City Council, amongst other things. She's also an SME advocate, and she said she's done some research that says 39% of small businesses believe they will never recover from this pandemic. So hang in there. What are the when is it a good idea just to wait and see versus maybe being proactive?
Well, I think it's got to be based on what your future cash flows look like. Once you assume a reasonable return on a conservative basis, what your return business will look like and what cash flow that will generate, and then comparing that to the debt load that you've inherited as a consequence of COVID. To see whether the future improvement in cash flow is going to be able to address that historical COVID debt load or not. If it's not going to be able to address it within an appropriate period of time, it's best to be proactive, I think, in terms of being able to present a plan to stakeholders about what you're going to do about that part of the historical debt load that you're not going to be able to address with future trading.
And I guess how long, I mean, let's say someone says to you, look, I can see there's a bit of a hole in the cash flow, but I'm going to hang on and wait and see. I mean, how long do you reckon they've got? We were talking before about when is the ATO going to sort of wake from its slumber. Most speculation is after the next election. I think most of us would expect an election before the middle of next year. Is that wise, just to sort of try and see if you can make a fist of it before the next election?
I think that's probably a bit too long in my view. Certainly for a number of businesses that are going to come back online, Christmas trading is going to be pretty critical to what they look like. And also, if they are able to have a significant uptick in cash flow collections over a Christmas period, that'll give them more options. So maybe a wait and see for a number of businesses through the Christmas trading period, and then do a reassessment come late January, early February. is probably a better time frame. Hanging out till the middle of next year, quite frankly, for many SMEs with very thin balance sheets, they're not going to last that long.
Yeah, I guess as someone in restructuring, I guess you like them to have a little bit of something to work with.
Yeah.
Otherwise, it does get very hard. Now, what about when should someone just because as the support comes away, right? So a lot of
Mm,
people are just staying open,
mm, mm,
because they've got
mm,
job saver. There's an
mm,
obligation there not to let any staff go while you're collecting the job saver. But under what circumstances should you just face reality and just shut the doors? And I'm interested because I know you're a bankruptcy
mm,
specialist as well. If you're trying to
mm.
save your skin, what's your advice there?
Well, once you've done your forward projections on a cash flow basis and compared that to what your debt load is, and if you can't address that debt load and all of that debt load, and then it comes down to, well, what are the attitude of those that have provided debt to you? I mean, if you've got let's say, an aggressive financier that's unwilling to work with you, or a landlord that's significantly out of the money because you haven't paid rent for significantly beyond where the bond monies provide protection to the landlord. If you've got aggressive creditors and you're uh, uh, unable to address all of that debt load, you got to work through your options in terms of a formal sense, both via the through the corporate entity, but then also if you've obviously given any personal guarantees in respect of, for example, to the landlord, what that impact is on you personally.
Yeah. And do you think those decisions, do those questions change depending on what industries you're in? I mean, obviously retailers, hospos. I don't know if you saw a
Mm,
couple of weeks ago, we had the transport, we had the travel,
mm,
airline
mm.
and hotel,
Yeah.
and we had the chairman of the travel association. I asked him what was keeping him busy. Actually, you'd be interested to
Mm.
know if you weren't watching, and he said he was every time his phone rang, there was one of his members, mainly travel agents, looking for insolvency advice.
Yeah.
Um, so I mean, does your thinking change there with that decision to close, depending on what industry they're in?
Um, Look, I think industry is important, but also there's been some industries where this COVID period has provided a lot of opportunity, particularly those in the IT space and also the space where converting work based practices into apps and IT platforms. They've really come on a pace. So yeah, to contrast to your retail and hospitality, uh, um, industries and transport industries, there are some winners out of here as well, and there's obviously a lot of players in industries that have had some pluses and minuses, and then there's also the the general catch-all that there are a lot of or a reasonable number of poor business decisions and poor business practices that occur irrespective of what industry a business is in.
Okay. Well, look, let's then talk about the. Let's say someone does say, "Look, regardless of the fact, I can survive this, but
Mm,
I'm going to really need it's, now that the
mm,
money's, the government support's drying up. I really
mm,
need to change my business,
mm,
either formally or informally." Now, as we've said, there's a lot of money around, and that's
mm,
finding its way to business balance sheets as well,
mm,
because with fintechs and
mm,
it's been very easy for all of them to load up on debt.
mm.
So, what are some of the considerations, for these but for COVID viable businesses? What's your advice? What are the things that you're looking for to see if they're? Firstly, let's talk about what are the things that you're looking for them to be able to be salvageable informally, and what are some of the things you're looking for if they're salvageable formally?
Well, salvageable is the key term. As it's whether whether there is a viable core business that is worth saving. If that's the case, well then that brings in, well, what are the options, formal or informal? That's more driven. I think that decision point is more driven around what the attitude is of the creditors of the company. If they're substantial players, those creditors that really want to maintain market presence and want to work with you. The prospects of informal arrangement, meeting an informal arrangement with a number of those players is relatively good. However, if, let's say, you've got a couple of large players that are supportive, but nonetheless a whole plethora of smaller players that are unsupportive, but nevertheless you need to bind them in order to provide the clean sheet you need to be able to move forward. That would play into the hands more of a formal restructure, and dusting off and utilising the tried and trusted VA regime.
Now we were talking earlier. I asked you what you were doing in 1991, and you said in
Mm.
1991 that was when you quit the Navy and went into business, which was interesting timing because you walked straight into the recession that we had to have.
Mm.
I mean, have you seen anything like it? Do the circumstances we have now remind you in any way of any of the circumstances in the past, 20 or 30 years? I mean, is there anything that you think back that you're able to fall back on? Like, it's certainly different than the GFC.
No is my answer. It's absolutely unique set of circumstances, and it's a fascinating time to be doing what we're doing, and I'm really looking forward to being part of the solution of helping people work their way through it. But no, I've not been in this situation before.
Now, I know that I don't know if this is under your purview necessarily, but I do know that DVT has been strong, may have even had a separate practice in
Mm.
succession planning. I know that that's been a thing from time to
Yep.
time, succession planning.
Mm.
And I guess one of the things that concerns me about small business is that what this whole pandemic has done. If you were maybe 5 years off retirement, your business is going really well. You've got a good cash flow, and your business is worth something because all those metrics that make businesses valuable. But now you've just had a hole blown in the side of the thing, and your retirement plans may well be gone up in smoke. So any special considerations, thinking about in a corporate restructuring scenario. Do those sort of two things interplay at all? The succession planning
Yeah.
and retirement planning and restructuring.
Yeah, they do. I've got to say, in our conversations with our accountant clients, that they're seeing for the first time in a long time a lot of succession planning activities and implementing succession plans actually occurring right now. Whilst the downside of COVID has been to, as you say, put a hole in the value of businesses, which impact the outgoing generation. But on the flip side, makes it easier for the new generation coming in, that acquiring a piece of the business becomes affordable. And also that new generation coming through is going to have a lot of energy in terms of reinvigorating a business or businesses that have stagnated during COVID. So certainly the messages I'm getting from accountants is that COVID's been a bit of a catalyst for implementing succession plans, particularly within family groupings.
Yeah, I mean, that's very interesting you talk about that. I mean, you sort of flippantly say it's a buying opportunity for the second generation.
Mm.
I mean, I've got a client at the moment who wants to buy the business off his father. His father says it's worth $3 million. I mean, I've looked at the financial statements. I reckon that's a pretty that's almost it's beyond even ASX multiples. So I'm not sure. Sort of. Oh, I can understand. The business does have assets in it, and I can understand how you can sort of come to that conclusion. But there does have to be a meeting of the minds as to what the business is actually worth. And 2 years ago you might have thought it was worth X, and as you say, today it's worth X, minus something.
Yeah, absolutely. So, I think it's providing a bit of a catalyst for those discussions to happen, and it's more often the case, particularly in family groupings, that the new generation does require the continuing, at least consultancy advice of the outgoing generation to maintain client relationships and the like. But you couple that with there being a surplus of debt and equity capital available to plug into these situations. I think it's resulted in a very active M&A market in the SME space in particular.
Well, that's the thing, of course. In the M&A space, I mean, if you've got a business that is still hitting its numbers, and plenty of businesses are still hitting their numbers, there's no doubt about it. Those businesses, I mean, it's never been a better time to sell because of the extremely low cost of capital. All of those pools of funds that have been welling up, as we demonstrated, we short showed the causes of some of those fund pools in some of those earlier slides. Super low interest rates, lots of money. Investment funds don't know where to put their money, so it's a great time to sell if you've got a good, solid, viable business that's hitting its numbers. But I guess it's a bit of the haves and have-nots. On the other hand, if you've got a business that's teetering on the edge, you want to sort of reclaim, get back to square, as we say, to try and put yourself in the right position as soon as possible, I suppose, while that money's still around.
Absolutely, I agree.
All right. Well, look, Mark, any sort of final thoughts before we close?
Oh, look, I think now's as good a time as any for business proprietors, particularly in the SME space, to make a projection into the future as to what their businesses are looking like. Have a focus on cash. See, whether you've got an insurmountable debt load or not. What are the attitude of those creditors? And if you need professional help, talk to your advisors, your financiers, to help you make the right decision to make the most of the post-COVID period.
Okay, well, look, we will finish on that note. So thank you very much, Mark, for coming along and joining us today. It's been very good of you to come along. I think, as I said, for our third visit, you're actually one of our most popular guests. I've always you're sort of a quiet, unassuming guy, although you're much loved in the industry. You're sort of one of the industry's gentlemen, if I'm still allowed to use that phrase. So maybe that's no surprise. But thank you very, very much for coming along again. I will say. Thank you very much to our viewers, live and non-live. If you enjoyed this, then please share, like, or subscribe on the platform that you're listening or viewing to now. I will say thanks for joining us, and we hope that you can make it again soon. Cheers.